That tech momentum was courtesy of chipmakers Nvidia and Broadcom, which each rose roughly 3%.
And here we are at 141, which is where we were trading after they reported earnings. An earnings report that we collectively said was very good. The margins were great. Everything was alike.
Nvidia just closed at $141.22 on June 3rd, up nearly 60% from its recent lows. But this isn't just another AI stock rally. The US, under President Trump, is rewriting its AI policy. And companies like Nvidia are riding that shift to the top. So, what's fueling the growth? And is it built to last? Since returning to office, President Trump has taken a much more aggressive approach to AI leadership. His administration rolled back earlier restrictions and launched a framework to accelerate US-led AI development. One key move was lifting the diffusion rule, opening the door for wider adoption of American-made AI stacks. That's been a tailwind for Nvidia, which powers most high-end AI systems today. Another shift: countries must now negotiate individually for access to US technology. That gives Washington leverage, but also adds complexity for companies planning long-term global strategies.
I read this really great report where 78% of global companies utilize some shape or form of AI, and that was from McKinsey.
Let's talk numbers. In the first quarter of its 2026 fiscal year, Nvidia posted revenue of $44.06 billion, a jump of 69% from the same period last year. Its data center division, driven by AI demand, contributed $39.1 billion, up 73% year over year. That surge comes as AI adoption hits an inflection point. According to a McKinsey report mentioned in a recent market segment, around 78% of global companies now use AI in some form, whether for automation, analytics, or real-time decision-making. Investment firms are also taking notice. Nvidia was recently added to Jefferies' highest conviction list, with demand accelerating in 4 key areas: AI inference, industrial robotics, agent-based systems, and enterprise AI stacks. Simply put, Nvidia's chips are no longer just about graphics. They're the backbone of modern compute infrastructure.
The White House said President Donald Trump and Chinese leader Xi Jinping are set to speak this week after Trump accused China of violating an agreement to roll back tariffs.
One of the few clouds on Nvidia's horizon is its exposure to China, which accounts for nearly half of the world's AI developers. Export restrictions from Washington have made it harder for Nvidia to sell its most advanced chips to Chinese firms. Estimates suggest that Nvidia lost more than $2.5 billion in revenue last quarter due to these restrictions. To adapt, the company is rolling out a new line of chips, codenamed H30 and P30, designed specifically to comply with US rules while retaining competitive performance. These are aimed squarely at the Chinese market and other restricted zones, and Nvidia's global role is expanding. CEO Jensen Huang recently accompanied President Trump on a diplomatic trip to the Middle East, where the US is pushing sovereign AI deals. These are nation-level partnerships to build AI infrastructure based on American technology, and Nvidia is a key supplier. As of June 4th, Nvidia's share price values the company at around $3.44 trillion. A Reuters report noted this briefly pushed Nvidia ahead of Microsoft as the most valuable company globally. Schwab Networks, the Big Three, highlighted price resistance between $144 and $153, with strong support near $130. Nvidia has rallied over 60% from recent lows around $130.86, with RSI showing potential for continued momentum. CNBC's Fast Money warned of a narrow rally, where a few tech giants, like Nvidia, are carrying the broader market. That dynamic can mask fragility under strong headline numbers. Nvidia's rise in 2025 isn't just about powerful chips. It's about policy, timing, and a tectonic shift in how global tech is regulated and deployed. As long as the US keeps pushing for AI dominance, and Nvidia remains central to that mission, the company stands to benefit. But whether this wave is sustainable or just another euphoric stretch in tech valuations, that's the question ahead. We'll be watching.
U.S. steel and aluminum prices soared on Monday after President Donald Trump said he would double tariffs on the two metals to 50%.
This week, a new wave of tariffs just took effect, and it's already shaking up U.S. manufacturing. On June 4th, the Trump administration officially doubled tariffs on imported steel and aluminum, from 25% to 50%. While metal producers are cheering, the auto industry is bracing for impact. Here's what you need to know about how this policy is affecting car prices, production, and investment strategy across the country.
The tariffs are pushing people to buy cars now, rather than, they're worried that...
Let's start with what looks like good news. Ford reported a 17% jump in U.S. vehicle sales in May, driven largely by strong demand for trucks and SUVs. But analysts say this spike isn't a sign of healthy growth. It's consumers buying early out of fear that prices are about to jump. That's because raw material costs, especially for steel, are about to hit automakers hard. At the same time, Stellantis and Nissan are facing serious inventory issues, with vehicles sitting on lots for 90 to 107 days, forcing deep discounts. And that's creating a dilemma for companies like GM and Ford. Do they raise prices to cover rising costs or cut prices to stay competitive? Either way, profit margins are getting squeezed.
So steel represents about 2,800 pounds of each car. It's over $1,000, almost $2,000 of cost for each car.
Here's why the pressure is so intense. According to Reuters and MSNBC, aluminum prices surged 54%, and U.S. hot-rolled coil steel rose 7.5% in the days after Trump's announcement. That adds $1,500 to $2,000 in production cost to every vehicle, based on average steel weight per car. Investors noticed. After the tariff hike, Ford and GM shares both dropped around 4%, reflecting market concern over profit outlooks. Meanwhile, steel and aluminum producers soared. Cleveland-Cliffs jumped 23%, Century Aluminum gained 21%, and Steel Dynamics rose over 10%. A sharp contrast showing who stands to win and who's left absorbing the blow. But tariffs don't just increase costs. They break production flow. Auto manufacturing depends on synchronized parts and just-in-time logistics. When input costs like steel and aluminum spike overnight, manufacturers scramble to renegotiate contracts, shift suppliers, or delay builds, each step adding more complexity and risk. According to Morgan Stanley, the U.S. still imports about 17% of its steel needs. So a sudden 50% tariff creates shock not just in pricing but in logistics and planning. Even automakers with domestic production capacity face bottlenecks and rework. These aren't abstract disruptions. They're changes that ripple through assembly lines, dealerships, and ultimately consumer wallets.
Lauren, General Motors is unplugging its big EV push, so to speak, and instead is now focusing on production of V8 engines, the ones that operate on gasoline.
As reported by Fox Business, the shift isn't ideological, it's economic. Automakers are now responding to tariff-driven cost realities, not just policy goals. The EV transition isn't being reversed, but it's being delayed, reshaped, and made more expensive. Electric vehicles depend heavily on aluminum and high-strength steel. When tariffs raise those input costs, production gets pricier, fast. That's part of why some automakers like GM are adjusting course. The company recently invested $888 million in V8 engine production in Buffalo, signaling a partial shift from an all-electric push. GM hasn't blamed tariffs directly, but rising input costs and unstable supply chains are clearly shaping new strategies, including a potential return to hybrids. Internationally, trade partners are watching closely. The global impact is just beginning. Canada and the EU are threatening retaliation, and trade talks with China are again under strain. Meanwhile, the OECD has cut U.S. GDP growth forecasts from 2.2% to 1.6%, citing rising production costs. Larry Summers warns, in 2018, steel tariffs added just 1,000 steel jobs, but downstream industries lost over 75,000. Tariffs may help U.S. steel mills, but they're straining automakers, dealerships, and consumers. If you're curious how this could affect what you drive or what you pay, hit like and subscribe to follow what happens next. Thanks for watching and see you in the next one.